Let's take a step back and just kind of recap this year's winners and losers so far. Winners have been the energy sector, like Inez was just kind of talking about with higher prices, but a loser has been tech. Anyone in those high-flying growth tech stocks like Facebook, like Netflix are hurting right now. Let's bring in Yahoo Finance markets editor Myles Udland, fresh face to the show.
Yeah,
Senior market.
Welcome.
Senior, also junior.
Senior and also junior, same time. Yeah, we love that. I want to ask you about just kind of the value trade, right? The value guys have had a long time, really.
Yep.
And the headline from Wall Street Journal, value investors take victory lap.
Yeah.
Bloomberg, a value investor, saying, quote, we look pretty stupid for a while. Mm-hmm. Do they look stupid now?
Well, I think what's funny about the value growth trade is that, I remember sitting at this desk, 26, well, the studio, what was the studio built? 19? So, whatever, 16, 17, 18, 19, same conversation, right? Value guys come on, and it's like, well, we'll have our day. And if you look at what happened in really 07, 08, and then in 02, 03, value has its day. It's usually an 18-month cycle. It's a pretty market outperformance, but it comes and goes pretty quickly, or at least it has in the last couple of cycles. And I think you combine those stories, and I'm kind of two minds in this. Certainly, the performance this year from value, a lot of it helped by energy, but just value in general has been, there's nothing else you can say, but it has been by far the way you want to be positioned in this market. On the other side, I can see growth folks sitting there saying, oh, perfect. We got headlines about how great value is doing. It's finally time to buy growth again.
Well, I was actually going to push back on that because you keep hearing sort of the decline of growth. These tech companies are finally having their day. Isn't it just about resetting expectations? That growth is still going to continue, not at the clip that we've seen over the last few years.
Yeah, I think there's so many things that are interesting within this market, and the growth, what has happened inside of growth and value on their own are things you could talk about all day. And I think the value side, it's an energy trade pretty much all the way, right? Those were the names that are a big component of, a value basket. So when energy's up, 50% this year? That's certainly going to help that
Put the
trade.
eggs on back in the Dow, man.
Well,
that's separate
morning brief tomorrow from Jared Blickery. Tune in on that. And then on the growth side, it continues to be like everything is just getting washed out, particularly at the lowest end. I have a few screens up on my Yahoo Finance. I wish we could share the portfolio with our viewers out there. But when I look at 2021 IPOs, so these are companies that are down 60, 70, 80, 90% from their highs. They're the outperformers today. Oatly, Coupang, Duolingo, Hims, Rivian. These are companies that investors have left for dead, but those are in the same basket, the same style as Amazon. Are we sure that we really need to be comparing those two? And then that's where you get, readings like growth is down 30% this year. It's like, well, some growth is.
Okay, so here's the question, though, right? Because the idea for value, regardless of where you are in the cycle, is, well, value is always on sale. Now, you have some people, though, that might be looking at, these big, high-flying growth stocks, especially Amazon post-stock split, and saying, aren't these on sale relatively now? So does that hurt the argument for value investors?
Well, I think the value investor defense, or what value investors have to deal with, let's call it mid-cycle, is people will say, well, why? It's value for a reason, right? And the answer, honestly, is usually yes. There is a reason why this company is trading at a discount to its value. The problem that I think a lot of investors are going to have on the other side of this is maybe Amazon's mark or whatever, what we're marking it to, the Facebook record high, maybe that was actually wrong. So now we're back at $190 a share on Facebook, Meta, as of Thursday. That's 2018 prices. Maybe it never should have been $500 a share. So there's a lot of issues.
I think that's the question for, what should these companies be valued at? I want to get back to the point you made earlier, though, about how these tech companies have all somehow been lumped in together. Mm-hmm. We've been hearing a lot of comparisons to 2000, is the bubble bursting? But you look at some of those big tech names. They've been around for a very long time. It's not like Pets.com, right. Back in the day.
They went public at much later stages.
At much later stages. Even a company like Uber, they'd been around for, roughly 10 years before they went public. So, I wonder if you can talk about that this differentiation that we're seeing instead of tech as a whole, and those tech companies that, maybe are not quite profitable are on the path, and then those who just, I'm thinking about, a Coinbase, a Rob. I mean,
Yeah, I mean, look, I think when we were having this conversation in 1819, when Uber was prepping its IPO and we were waiting for these companies to come public, there was is this the tech bubble? Well, guess what? We got it last year. The SPAC boom was the tech bubble. Those are the companies that are literally not going to make it.
Yeah.
These companies will go out of business. These stocks will be zeros. I'm not breaking any news here. The market is clearly judging that to be the case. But, many of them are going to not make it in the public markets, which is what happened during the tech bubble. I think what is challenging right now for investors is, and the story that I've been thinking a lot about is, let's take Microsoft. Microsoft was dead money from 2000 to 2015.
Yeah, nothing happened.
And now I think you need to start thinking or being realistic, running through the scenario. What if some of the FANG names just go nowhere for a long time? Microsoft's revenue and profits, they were all up considerably over that 15-year period. The stock didn't go anywhere. And there's a lot of reasons why that may have been the case. Maybe you disagreed with it. Maybe Microsoft, Microsoft became a value trap at that time. And I think that there's going to be this sort of new version of that conversation. Uber, in many ways, has already been a value trap. It was valued at $100 billion 6 years ago. And now it's worth half that, maybe less than half that, depending on where exactly the stock trades. And I think there's a lot of businesses out there like that. And a lot of folks, and you see it every day in the press, a lot of folks who run a lot of money who've never gone through that cycle. Everyone takes shots at Twitter guys. They don't know anything about it. It's like, yeah, well, I think there's people running billions and billions of dollars who are like 38, and they just hadn't seen that cycle.
Yeah, well, fire movement. By the way, I unearthed one tweet that you had. Marriages like deep value strategies are about keeping the faith.
I said that?
So you said that November 9, 2020, I think.
Oh, you went way back.
Yeah.
Well, that's the great thing
about Twitter.
It was like a month after I got married, too.
There it
I
is.
really knew what I was talking about, of course.
You agree? You
obviously.
still agree? You're still sticking with that?
Sure, yeah.
Which part?
You don't legally have to answer this question.
I'm not going to ask you to wait on your
If Pam's
marriage.
watching.
Yeah, look, it'd be better to, I think it's probably better to structure your relationships the way a value investor thinks about their portfolio than the way growth thinks about portfolio.
Okay. Junior Senior Markets Editor Myles Udland, thanks for jumping on today.